I'm Stan Barnes, and I'm here with Eddie Hatch, and we're Barnes Capital Group. We'd like to welcome you to the 7th edition of Barnes Quarterly. On our last call, I had said that this was at the beginning of the coronavirus last quarter, and I believe I said that when we tape the next call that I hope we would be out of this. Unfortunately, we are not, as you all know, but I do hope that you and your families are coping with the environment that we find ourselves in and dealing with the stress and hopefully finding some time to get outside and enjoy being together. Just wanted to mention we are settled into our new offices at 1801 Hermitage Boulevard. The building is pretty empty at this point, but we would welcome you to come by. We are exercising the precautions of wearing masks in the common areas in the building, and you will be greeted by our doorman who will ask you a few questions. It seems like we've had a year's worth of market movements and volatility that we typically experience in a year. It's been crammed into a quarter. And so we're going to be visiting today with our Chief Investment Officer, Chris Zaccarelli, who will hopefully help us make some sense of what's been going on in the markets. But before we do that, I'd like to turn the mic over to Eddie Hatch here to introduce what we think is, we're very excited about it. We think it's a very innovative tool that hopefully our clients are going to find some value in. It's known as Riskalyze. And with that, Eddie, tell us a little bit about that.
Yeah, Riskalyze was a program that was developed by people that were much smarter than I am. They basically are taking a lot of market data, statistics, and computer algorithms to help develop a quantifiable evaluation of an individual's risk tolerance. They call it the risk number. For so long, advisors have tried to base a person's risk off of some stereotype or their person's age. They use words like moderate or aggressive. And those words tend to be very subjective. Aggressive might mean one thing to one person, but something completely different to another. And so this is a way of sort of quantifying that process and assigning an actual number to each person. It helps kind of tell them how much risk they're willing to take, but it also kind of gives them some probabilities of what their potential outcomes for their portfolio may be. It's a way of sort of showing them what their particular portfolio might look like over different time periods, whether it's 6 months or a year or 5 years from now. And so they can see what that potential upside and downside may actually look like. It's designed to help set better expectations of performance so that investors can make better informed decisions over what their long-term goals are, instead of reacting to the volatility and making irrational decisions that tend to hurt their performance over time.
So just to kind of restate, it helps us, number one, align the portfolios that we're investing with the risk expectations of the client. And so it helps on both ends of the equation. It helps the client have a better understanding of what risk they're taking, but it also guides us in selecting the investments for them and making sure those two things align with one another.
Yeah, the way they've designed it is much like a speed limit. They actually assign a number 1 through 100 of what your particular risk tolerance is, and then it allows us to go in and design an individualized portfolio just for you that meets that same number. If your risk tolerance score is a 60, then we can design a portfolio that matches that particular risk tolerance.
Well, at Barnes Capital Group, we've always prided ourselves on tailoring investment strategies and planning to our clients' individual needs. Riskalyze just adds another additional element of transparency and efficiency to the process.
For some of you, we have already started introducing Riskalyze, but for others, feel free to reach out to us if you want more information. But we will also be talking to many of you in the near future.
So, Chris, we really appreciate you taking time out to visit with us today. I know you're on vacation with your family. Where are you hailing from today?
So I'm calling from the mountains of North Carolina. We're about 20 minutes outside of Asheville. Pretty nice up here. It's beautiful views and great mountains, and a nice getaway from the greater Charlotte area in the summertime. Get kind of beat the heat.
They got some pretty good bluegrass up that way as well.
Yep, some good music and some good food and some nice breweries as well.
Well, very good. Well, I won't, in an effort not to keep you too long, let's get to the topics at hand. Obviously, we've been through a very sort of unprecedented time in our country and in the markets. And just talk to us a little bit about sort of the impacts of the current events, I guess I'll call it, COVID, and how they've impacted the markets and what we're seeing and what we should look to going forward.
Yeah, it's definitely been an unprecedented year. That's a word that's been used quite a bit, and it's pretty apt. It's unusual in so many different cases, both in terms of this recession, in terms of the market reaction, and even in terms of the scale and duration of what we've experienced so far. Really looking back on the year to date for 2020, we started off with the markets moving higher, kind of continuing momentum from 2019. The economy was doing well. Unemployment was at 50-year lows, and it seemed like that trend was going to continue. And then all of a sudden, COVID-19 came out of China and spread to the rest of the world relatively quickly, and the stock market reacted accordingly, dropping about 34% from February 19th to March 23rd, which is one of the fastest drops out of a bull market into a bear market on record. Now, that's the market side of things. On the economic side of things, which obviously takes a little bit longer, markets are forward-looking, but from an economic point of view, we just had our second quarter GDP numbers, which were reported at the end of July, about a week before this taping, and GDP dropped about 33% on an annualized basis. So it's pretty interesting that the stock market many months ahead of time dropped 34%, and then here we are in the middle of the summer seeing GDP dropping at an annual rate of 33%. I'm sure some of that's a coincidence, but it's pretty amazing how markets are quick to price in future events and handicap the scale and the damage or opportunity of those events.
No, it has certainly been crazy. Just out of curiosity, what sectors have kind of weathered this sort of whipsaw in the markets? What's done well, I guess?
Sure. There's a lot of dispersion this year in terms of having some sectors do really well and other sectors do really poorly. So as we're recording this, the S&P is up around 4% for the year. And so you have some sectors like technology, which have done very well, that are up 25%. Or even consumer discretionary up close to 12%. And then you have other sectors, more cyclical sectors that are prone to changes in earnings and are hit harder by the economy typically, such as industrials, financials, and energy. And so industrials are down about 9%, financials down about 20%, and energy is down around 36%. So there's been a pretty wide variation between the best performing sector and the worst.
Wow, that is significant. Well, one area that's just inevitable in any discussion about the markets, and that is we're cranking up with election season and most notably the presidential election. Talk to us a little bit about what you would expect to see in this particular race, and then put it in some historic perspective.
So it's interesting. Here we are in 2020, just 4 years after the 2016 election. And we've got a similar setup. The difference is Donald Trump, instead of being a political newbie and someone who didn't have a lot of history on the political side, but was a well-known personality both in business and entertainment, is now the incumbent. But as you all remember, back in 2016, you had a well-established Democrat, in the case of Hillary Clinton, who was predicted to win, not by a wide margin, but she was up probably about 10 points. Let's call it maybe 60% chance of winning, somewhere in the 55 to 60% chance of winning. And you had Donald Trump, who was polling pretty poorly and not expected to win the nomination. And sure enough, he won, as we all know, and that really surprised a lot of pollsters. So now fast forward to 2020, where you've got Joe Biden, another very well-known, well-established figure within the Democratic Party. He's up by around 7 or 8 points, depending on which polls you look at. And Donald Trump, despite being the incumbent, is the underdog yet again. So I'm not going to say history is going to repeat itself. I'm not a political forecaster like a Nate Silver or someone of that ilk, but I do follow a lot of their analysis pretty closely. And so I have to say, if you were not humbled by your predictions in 2016, you should sure be a lot more humble in 2020. So I would say the odds do favor Joe Biden at this point. It's pretty early on, and clearly both polls and consensus can and will be wrong. So I think it's going to be one to watch, and we'll have to keep an eye on as we get further into the fall.
Handicap, if you would, for us, assuming there's a Trump win, and then contrast it with what might happen in terms of the markets with a Biden win.
So again, these things are really difficult to predict. If you remember back in 2016, a lot of people were predicting that Trump, if he were to win, would drive the markets down quite a bit, both because he wasn't a career politician and didn't really know how the machinery of Washington worked, and there was a lot of expectations that he would govern in an unpredictable fashion. And sure enough, the night of his election, as it looked like he was winning, the futures were down quite a bit, and the stock market really sold off. But by the time we woke up the next morning, markets moved higher and really never looked back until we got to the COVID crisis. And so again, I think it's a case of it's very easy to try to handicap what the markets will do. It's very difficult to know what will actually happen. So that being said, with that grain of salt, I would say I think the markets are in a really unusual place, in that I think conventional wisdom assumes that given a Democratic president with potentially a Democratic Congress, both in the House and the Senate, if the Senate were to flip as well, there's a lot of consensus out there that would be bad for the stock market. And I think if you look at the underlying facts as far as corporate tax rates going up, regulation going higher, I would agree that all things being equal, higher taxes and more regulation would be bad for corporate earnings and should be bad for the stock market. However, this is not a typical year whatsoever. I think the amount of fiscal stimulus that you have in the system, both from the federal government as well as from the Federal Reserve, is really unprecedented. The last time you saw something like this was back in 2008. We all knew what happened in 2009, 10, 11, where the stock market really took off. I think there's a lot of money in the system. I think there's a lot of pressure on asset prices. And I wouldn't be surprised, regardless of who won, that as long as the economy continues to recover, eventually we get past this health crisis, you could see markets moving higher. So I think it's a lot harder to say in this particular time, and I would be a little bit more skeptical of those who think that the stock market would go down and stay down in either outcome.
So the stimulus that you talked about, would you say that's the reason that the market seems to be rallying against the headwinds that it's facing right now, or is it some other reason?
I think that's one of the largest reasons, certainly. I think both the Federal Reserve stepping in a similarly dramatic fashion to how they did during the financial crisis. The only difference is they use the same amount of firepower in a lot shorter period of time. So in a sense, what the Fed has done this time is even more dramatic than what they did last time. And then secondly, the big difference is this time around, there's also fiscal stimulus in terms of actual money being put into the economy aside from the Federal Reserve. And that's through all of the government programs that have been put into place. And I think those two factors, more than anything else, are really what are pushing markets higher so far this year and are likely to continue pushing markets higher, even in the face of what could be some pullbacks or market volatility as various scenarios unfold in both the virus as well as politically.
This is my last question, and it's kind of a two-part question. Eddie and I were in a investment committee meeting last week with one of our institutional clients, and one of their investment committee members asked the question, what did we see happening in the next 18 to 24 months? And we get that question a lot now that the market's kind of recovered at least some degree. Now that we're back to where we were, should we take money out and sit on the sidelines, or where do you see things, in the next year or two in terms of any clouds on the horizon? And I know that's kind of an impossible question to answer with any accuracy, but just kind of give us some things to think about. And the second part of that question was, our interest rates right now are essentially at zero in terms of where the Fed set them. And, given the fact that interest rates are just sort of at an all-time low, is there a place for bonds in your portfolio allocation of your investments?
Sure. And those are great questions. I think everyone is always looking to have an investment horizon, both long-term as well as medium-term. And, no one knows what's going to happen in the next day or the next month, but over an 18 to 24 months time horizon, you are looking to see, are things likely to improve or are things likely to take a turn for the worse? It's impossible to predict black swans, and that's why they're named as such. But ultimately, you're just looking at what's likely to occur. And so again, I think you want to look back on what's happening with all this stimulus. Ultimately, what's going to be moving the economy higher and what's going to be moving financial markets higher at times will diverge and at other times will come back together. But in the short run, which would include that 12 to let's say 18-month time horizon, you really have so much stimulus in the system that it's very difficult to fight the Fed or to try to anticipate when the market is going to give up those gains. You really kind of have a win at your back as an equity investor. That being said, as a bond investor, you're focused typically not necessarily on the path of interest rates, although of course that's very important, but oftentimes you're focused on whether or not you'll actually get your money back. How good is the credit quality? And this is one of those times where, given the pricing that had gone lower at one point, you were really being paid to take a lot of risk. I would agree that with interest rates relatively low and bond prices relatively high, the risk reward set up for stocks versus bonds are in favor of stocks over bonds. However, I would not discount the importance of bonds in a portfolio. They always provide multiple reasons. The first reason is for liquidity. So to the extent that you're taking money out of your portfolio, whether that's spending needs of an institution or an individual in retirement or who's looking to take some money out of their portfolios, having bonds both providing current income in terms of coupons as well as relative price stability is really important, because the last thing you want to do is be accessing funds within your account out of the stock portion of your account in the event that the stock market does go down. Because as we've all seen time and time again, no matter how good things look, like they did at the end of 2019, black swans like the coronavirus is just yet another example, can happen at any time and really knock down the value of your portfolio. So that's stability in your portfolio, the liquidity that comes from owning bonds. And then lastly, the idea of ballast, the idea that most people can't withstand a 40% drop in their actual account value. So therefore, you would not want to be 100% in the stock market. To the extent that you can withstand larger drawdowns in your portfolio because you've got a longer time horizon, you can have more money in the stock market. But it's very unusual that someone would have both the risk tolerance as well as the time horizon to be 100% equities. So for that reason, you're always going to want to have some portion of bonds in your portfolio. So hopefully that answers the question of whether or not we think bonds are important, because we do. Of course, we have to be very careful that with bonds, interest rates at all-time lows, you want to be careful of having a duration that's too long. So if you can have a shorter duration, all things being equal, that will provide a little bit less ballast on the downside, but will give you a little bit less risk in the event that the economy does recover and interest rates go higher. As far as what's likely to happen, let's say in that medium time frame, it's as you mentioned, always very difficult to predict. But one thing I would take away is that the Federal Reserve has spoken many times about how they plan on keeping interest rates low for an extended period of time. And so all things being equal, with very low interest rates, that's typically very good for the stock market. So if I had an 18 to 24 month time horizon, given what the Federal Reserve has pledged to do, given what we've experienced in terms of the amount of fiscal stimulus and the likelihood that both the Federal Reserve as well as the federal government is less likely to take away that stimulus, I would say you've got the wind at your back, and I would expect, unless we have some black swan or some other unanticipated event, that being in the stock market and staying fully invested through the election and beyond is probably the right thing to do at this time.
Well, very good. Well, listen, we don't want to take any more of your time since you are on vacation, and we really just appreciate you taking a pause to visit with us a little bit here today, and hope the rest of your vacation is enjoyable. You get some rest up there, and the weather's good.
Thanks so much. I really appreciate it. Great speaking to you and your clients as always, and I hope everyone stays well and stay safe.
We'd just like to thank everybody for tuning in to Barnes Quarterly, but before we sign off, I've saved the best for last. Eddie's got some news to tell our listening audience.
Thanks, Dan. Yeah, my wife and we're expecting our second child. We have a baby boy on the way in the middle of October sometime.
So that's obviously fantastic news, and he will be joining his big sister Charlie in a new home. Eddie is in the process of moving as well, so he's deciding to add the stress of moving and a new child to the stress that the markets have been providing and COVID.
Yep, lots of changes this year.
Again, thank you all for tuning in, and as always, drop us a line or give us a call if you have any questions or want additional information on what we've talked about today. Hope you and your family stay healthy and safe.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referencing is historical and no guarantee of future results. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.